Good evening, Bill Bracey from Sydney Financial Planning. It's budget night, which is an exciting time for nerds, especially people in financial planning. So lots of changes come out tonight, and we're going to start off with superannuation. So you can see on the screen beside me, the first one, they've reduced some of the contribution amounts that you can put into super. First of all is what we call the deductible contributions, which is the taxed part of it. In other words, people are salary sacrificing, or if you're self-employed, getting a tax deduction. And they've reduced that broadly from about 30 to 35,000 down to 25,000 per year. Secondly, if you're earning more than 250,000 a year in private income or as a salary, that your superannuation will be taxed at a higher amount. Instead of paying 15% tax, you'll actually be paying 30% tax. But that's only for people who earn over 250,000, as here. One of the major changes has been how much money really you can have in super when you retire. So what they're saying is you can have up to $1.6 million in super. For most of us, that's not going to be a major problem. But for a number of people who have used superannuation as a structure to not pay any tax because they've gone to a clever financial planner, like Sydney Financial Planning, now what we're saying is, it's not we, the government's saying, but they're going to cap the amount that you can actually have it in a tax-free allocated pension of up to 1.6 million. Last significant super change is the amount of money that you can put into a super with after-tax income. In other words, you're not getting any tax deduction, and that's $500,000 over a lifetime. Where at the moment, and in the past, you could put up to $180,000 a year with after-tax income each year all the way up to age 74 if you were working. Now it's a maximum $500,000. The next changes to the budget released tonight, which are going to affect our clients, is on tax. Two parts to this. First of all, company tax. Company tax for small businesses are going to be reduced from 29% down to 27.5%. From the 1st of July this year. That's a significant change for most of our clients who are small business owners, because the old rule was small business was defined by someone who had a turnover of 2 million or less. That's now increased to 10 million. That's a significant difference for most of our clients who are small business, self-employed type people. Secondly, for the people who are not self-employed, the mum and dad employees, there's a small change, and they've increased the threshold of one of the tax brackets from 80,000, which currently you pay 30% tax, up to 87,000. So that last 7,000, you're paying a lower amount of tax. Reasonably insignificant amount for most people though. So in summary, a lot of changes in super. In essence, I can see that they're effectively putting the brake on super if it seems too good to be true. Sometimes it can be too good to be true. The government's worked out, but not enough people are paying tax in super because the financial planners have been too clever. So they've, sorry, we're probably to blame. So basically they're trying to slow some of the contributions getting into super, but probably the biggest one, as I see, is that cap of 1.6 million. For most people that's not a problem, but for about 1% of the population and many of our clients, that is going to be a change because they were hoping to have more than that in their super. But 1.6 million tax-free and as an investment, and the income coming off that being tax-free is quite significant. So it does change our advice moving forward and how we're going to advise you for wealth creation. So at your next review, or if you don't want to wait for your next review, you need to talk to us sooner, please pick up the phone and phone us at Sydney Financial Planning and ask for your financial planner. Been fun to look at the budget, and see you again next year. Peter Harvey, Canberra.